In the 1990s, Wall Street believed math could tame risk forever. Turns out, risk didn't read the textbook. One hedge fund claimed it had cracked the code of uncertainty. Yes, they brought equations to a knife fight. Their models were elegant, complex, and extremely confident, like a weather forecast that lifts weights. The fund was Long-Term Capital Management, or LTCM. The name was long, the risks were longer. It was founded in 1994 by bond legend John Meriwether. He traded bonds like chefs use knives. He previously ruled the bond desk at Salomon Brothers. Yes, ruled, with spreadsheets and caffeine. Meriwether recruited the Avengers of finance academics. Capes replaced by tenure and chalk dust. 2 Nobel Prize economists joined the fund's core team. When Nobel shows up, people stop asking questions. Their names were Robert Merton and Myron Scholes. Yes, actual Nobel winners, not trivia night champions. They helped build modern options pricing theory. Basically, math that taught markets new tricks. Also on board was David Mullins, former Federal Reserve Vice Chairman. When regulators join you, that feels reassuring. The partner list read like a finance all-star roster. No benchwarmers, only spreadsheet athletes. Their strategy was convergence arbitrage in bond markets. Small price gaps were their favorite snacks. Buy the cheap bond, short the expensive twin. Wait patiently and collect the difference. It worked beautifully in calm markets. Like surfing, as long as the ocean behaves. Early returns topped 20% annually. Investors smiled so hard it hurt. But access was exclusive and invitation only. Even rich people needed a referral. Minimum investments were massive by design. If you had to ask, you couldn't afford it. Investors included major banks and global institutions. Basically, the financial VIP lounge was fully booked. LTCM looked less like a fund and more like a brain trust. A very expensive, very confident brain trust. Their computers ran complex pricing and risk models daily. The machines never slept, unlike the interns. Risk controls looked strong on paper and in code. Reality, however, does not run beta tests. The models assumed markets behaved rationally over time. Markets laughed quietly and loaded a pie. Price gaps between similar bonds should eventually shrink. That was the beautiful theory anyway. To magnify tiny gains, LTCM used heavy borrowing. Leverage was their favorite protein shake. They borrowed many dollars for every dollar invested. Like buying a mansion with couch money. Leverage ratios reached roughly 25-1 or more. Great in sunshine, terrible in hurricanes. Big Wall Street banks eagerly provided financing in trades. Everyone wanted a seat on the genius train. Major counterparties lined up to do business with them. Smart money loves smarter-looking money. By 1997, the fund managed billions and huge positions. The engine was roaring, bolts already loose. Behind the scenes, LTCM stacked trades across global bond markets. Quiet moves, gigantic size, zero spotlight preferred. Their favorite play was convergence arbitrage between similar bonds. Twins separated at birth, reunited for profit. They bought undervalued bonds and shorted overpriced ones. Like coupon hunting, but with jet fuel. Normally, price spreads drift back toward historical norms. Normally is doing heavy lifting here. To scale profits, they use derivatives and swap contracts. Financial side dishes with nuclear calories. Notional exposure climbed into the trillion-dollar range. Yes, with a T, not a typo. Banks like Goldman Sachs and JP Morgan cleared trades. When giants shake hands, tables can shake too. Merrill Lynch, UBS, and Deutsche Bank were involved. It was a very crowded dance floor. Credit lines were generous because LTCM rarely lost. Success is the best short-term reference letter. But leverage makes small errors grow teeth fast. Cute kittens become financial lions. The model's assumed correlations stayed mostly stable. Markets prefer improv comedy over scripts. Liquidity was assumed to be available during stress. That assumption would age like milk. In early 1998, cracks formed in global markets. Stress traveled faster than overnight mail. Asia had already faced a financial crisis in 1997. Contagion was the unwanted sequel. Volatility began rising across bonds and currencies. Calm charts started drinking espresso. LTCM increased positions to recover smaller losses. Doubling down rarely wins poker or finance. Risk grew while confidence stayed strangely high. Optimism can be very well dressed. Then came the shock that broke the math. Russia entered the chat loudly. In August 1998, Russia defaulted on domestic debt. Markets hate surprises without cake. The Russian financial crisis triggered global fear instantly. Investors ran toward safety like sprinters. Government bond spreads exploded instead of shrinking. LTCM's core bet flipped upside down. Trades designed to converge moved violently apart. The math started sweating bullets. Losses hit across many positions at once. Diversification took a personal day. Liquidity vanished as everyone tried to exit. Doors are small during stampedes. Margin calls arrived from multiple banks quickly. Phone lines became instruments of fear. Collateral demands rose as positions fell in value. Gravity works in finance too. Selling positions would push prices even worse. The exit door was on fire. Partners searched for private rescue investors urgently. Pride was replaced by phone calls. Potential rescuers demanded deep discounts and control. Sharks do not offer friendly hugs. Systemic risk fears reached the Federal Reserve. Wall Street's smoke alarm was ringing. Officials feared a forced LTCM collapse could freeze markets. Too many banks were tied to the same rope. Exposure chains linked nearly every major Wall Street bank. Financial dominoes were standing very close together. The New York Fed organized closed-door meetings quickly. No cameras, no leaks, extra coffee. New York Fed President William McDonough led talks. Calm voice, very loud problem. Banks were urged to coordinate a private sector rescue. Translation: fix this before it explodes. No taxpayer money would be used directly, but the pressure level was government grade. 14 major banks agreed to join the rescue group. Competitors became teammates very fast. They injected about $3.6 billion total. A very expensive group project. In return, banks received 90% ownership control. Genius came with a clearance sale. Goldman Sachs and J.P. Morgan were key participants. When heavyweights lift, markets breathe easier. Morgan Stanley, UBS, and Credit Suisse joined too. Global problems require global checkbooks. The goal was an orderly unwind of positions. Slow surgery, not financial chainsaw. Markets stabilized once the rescue was announced. Panic took a short coffee break. LTCM stopped being a star hedge fund overnight. More like a supervised science experiment. Positions were reduced gradually over months. Very careful financial diffusing work. Losses totaled several $billion overall. Expensive lesson, no refund policy. The Nobel reputations took public criticism. Even brilliant math wears mud sometimes. Quant models were re-examined across Wall Street. Spreadsheets received suspicious side eye. Risk management rules tightened at major banks. Seatbelts were suddenly fashionable. Regulators studied hedge fund leverage more closely. Flashlights entered dark corners. The crisis previewed dangers seen again in 2008. History loves reruns with bigger budgets. Key Lesson 1. Models are not reality. Nature ignores elegant equations daily. Lesson 2. Liquidity disappears when needed most. Umbrellas arrive after the storm. Lesson 3. Leverage magnifies everything, especially mistakes. Volume knobs stuck on maximum. Lesson 4. Financial networks spread trouble quickly. Contagion travels first class. LTCM became a legend and a warning. A very expensive cautionary tale. Brilliance built the machine, leverage stressed it. Reality pulled the plug. Wall Street survived, but with new humility installed. Software update. Caution version 1. Future crises would echo similar patterns again. Different names, same human habits. Perfect equations nearly caused imperfect chaos. Markets remain human, stubborn, and undefeated.